is the trade still, like, forget the speculation on AMC, is the trade still the reopening, the value trade?
I think it is, and I think that that's what you're going to see for the rest of the year. And it's not only the reopening in terms of, we all are getting vaccinated and we're able to go out to restaurants and enjoy our lives, but the amount of stimulus that's in the system is really profound, and that's getting put to work, and it's helping energy companies and mining companies and all kinds of industrial names, all kinds of old economy stocks that are really getting lifted by this.
Do you like small caps, though?
I do like small caps. They've run so much harder than listen, you would think that they would do well. They have, but they've really run harder than the broad market. They've been an outperformer. I think if you're looking to make a cyclical trade, I would focus it on value over growth rather than on small versus large. But I do like small caps. And I would also focus it on sectors. I would rotate away from more defensive stocks into companies that are more economically sensitive. But, if you said small caps, yes or no, they probably still have a little bit of juice, but less attractive rather than some of these other things.
So then what do you make of a day like today, where we have that jobs number that sort of took immediate Fed talking about tapering off the table, so you get the rally in the NASDAQ, et cetera. Financials kind of take a break on that flatter yield curve. What do you do on days like this? Are they anomalies to you then?
Well, first of all, Alex, I just want to, I don't want to say correct the record, but if the Fed is responding to a single data point, like you're implying that this is going to change their outlook on what they're going to do, then I'd be really scared. I don't think that that's going to be the case at all. I think that they've been very clear in a broad path. They want to bring the unemployment rate down substantially from where it's been. It's moving in the right direction. To me, the number that's not getting a lot of attention is that wages, our average hourly earnings surprised to the upside, which is a sign that all of the stimulus is working and creating, upward pressure on inflation. So I'm not sure that today changes that much. For me, it tells me that there's not a big disappointment here. Incrementally, the trade is still on.
Okay, so trade's still on. However, when you look at those wages, what sectors tend to feel the most margin pressure from wages? And do you need to start factoring that into your PEs, to your earnings estimates?
Well, so the way that you're framing this question is that higher wages are a bad thing. So first of all, it does mean that people are going to be more confident in their jobs, in the ability to spend money. But also what we're finding is that as we're seeing inflationary pressure, and you're seeing it in wages, you're seeing it in commodity prices. I see it when I go out to a restaurant. But businesses are able to pass on higher expenses with real ease right now. So profit margins, surprisingly, have not been under pressure. If you look at the first quarter earnings, the revenue surprised by about 4%. The margin surprised by something like 16%. Where is that coming from? It's the ability to pass it on. So yes, retailers are absolutely going to feel more pressure from things like wages, as would fast food restaurants. But if you ask me whether their margins are going to come down, I don't think so, because their volumes are going to be higher and they're going to incrementally increase prices on their menus and the like.
So you mentioned then basic resources, energy, and materials being a favorite spot for you right now. They did have a really good run, particularly when copper got to 10,000. So I'm wondering where you see the next leg up. Where's the next juice? What's the next catalyst going to come from?
Well, so first of all, and if you look at the commodity space, it's not all the same. But I do think if you look at the oil companies, there's a real disincentive for these energy companies to be doing more exploration. They're being incentivized to put money in renewables and the like. We're getting a lot of we're spending a lot of time here at Credit Suisse on ESG related issues. And to that extent, you normally see a certain type of a supply response. Oil prices go up, energy companies drill for more. But right now, it's not clear that they're going to be doing that additional exploration activity or extraction activity. And that could keep oil prices a bit higher. So that's one area. As relates to something like copper, copper not only does well with a generally strong economy, but there's a lot of copper in things like electric vehicles. So this new economy that we're moving into is going to have a lot of demand for this stuff. So I think that there's reason to believe that this commodity trade, many people calling it a commodity super cycle, has the potential to have further to run.